Hey, what's up, folks? It's Wayne. Exciting news. Mortgage rates have dropped the lowest they've been in about 5 months. So today they're at 6.15% on a 30-year fix. They're at 5.38% on a 15-year fix. So this isn't just information coming from me. This is from Fox Biz. This is from Yahoo Finance, Forbes. They're all shouting to the rooftops to let people know that now is a good time to purchase a property because the rates have actually come down. Yes, mortgage rates have dropped. As a result of this drop, we've seen 28% more mortgage applications, 28% rise in mortgage applications because people just literally heard about this in the last couple of days. They dropped last week, but they've really dropped as of today, January 19th, 2023. So to put it basically, what does that mean if you go to purchase a property? That means that if you go to purchase a property right now and you get a 6.15% 30-year fixed rate mortgage, that's going to put your mortgage payment at about $62 for every $10,000 that you borrow. So if it's a $300,000 house or a $400,000 house or $250,000, you can basically divide $10,000 into that and do the math. You can see how if you bought a $100,000 house, for example, then your mortgage payment, principal and interest on that is going to be $620 a month. Now you have to add in taxes and insurance and mortgage insurance premium, which is going to put it still at about $850, $900 a month. Lots of variables there because some taxes are higher than others and some insurance is higher than others, but you can get a good perspective of your principal and interest payment is $62 on every $10,000 that you borrow on a mortgage. Now with the rate adjustment to 6.1%, we're still not seeing a huge surge in refinance and people refinancing properly, mainly because such a large amount of people have a 5% or lower mortgage rate. So when it's at 6.1% and you're sitting at 5.5%, 5.25%, even if you're sitting at about 6.5%, you don't really want to jump on the whole let me refinance. So you definitely want to do the research and do the math and make sure that it makes sense for you. So what are they saying? Sam Hodder, the chief economist at Freddie Mac, saying this interest rate drop is causing a much needed boost for especially for first-time home buyers as we roll into the spring housing market in 2023. So last week the consumer price index showed an overall decline of 0.1%, and that decline is partially what's fueling the lower mortgage rates. So that data alerted to investors that the Federal Reserve is going to be tapering off the rising of the mortgage rates, and in doing so, looking at the consumer price index, taking such a small decline, it's still a good thing, showing that inflation is just about tapered off. Now keep in mind the Federal Reserve does not set the interest rate that the borrowers pay on a mortgage. However, their actions influence them. Now mortgage rates tend to track the 10-year Treasury bond, and that basically just follows the anticipation of what the Federal Reserve is going to do. I know it sounds crazy. So when Treasury yields go up, mortgage rates go up. When Treasury yields go down, mortgage rates go down. Now, although we did see slower inflation in the month of December, it's still a concern for people and business owners selling goods and commodities because we've seen a slowdown in inflation, but we also seen a slowdown in inflation because we've seen a slowdown in consumer purchases. Now look, we can't talk about all this. We can't talk about interest rates and the economy, and we can't talk about any of this information. We got to look at the labor market. So how is the labor market? The labor market is still strong despite some layoffs in the tech sector. I mean, through the month of December, the national unemployment level was at a long-term low. So all this means that we have to look at the last half of last year, and home sales dropped dramatically. Now home prices, they're still pretty stable, and the reason why they're still pretty stable is because people pretty much slowed the process of purchasing houses, and the inventory of homes on the market has pretty much remained the same. So that means that houses are staying on the market for a little bit longer, but it's really hyper-local. So it just depends on the price range, the location, what city you're in, whether or not those prices of those houses are coming down. So what does all this mean for 2023? Personally, I think we're going to see a fluctuation of rates. I think they're going to drop them and then they're going to raise them. They're going to drop them, they're going to raise them. They're going to drop them, they're going to raise them. How far they'll drop them, who knows? How much they'll raise them, who knows? But one thing is for certain, that it's still a seller's market. People are putting their homes on the market. They're going to be putting more homes on the market. Homes are staying on the market a little bit longer because when they raised the rates, that slowed the housing market down tremendously. And in slowing the housing market down, it pretty much caused a domino effect for everything to slow down. But I think that as we are stabilizing with inflation, and the numbers are there, the proof is there that it's stabilizing. I know a lot of people are like, stabilizing, where are you at, dude? But the numbers show that it is stabilizing, and since it's stable, they have adjusted the rates down, 6.1% on a 30-year fixed, 5.35 on a 15-year fixed. If you're thinking about buying a house, who knows what they're going to be next week, 2 weeks from now. They may be lower, they may be higher. But if you're looking to purchase a property, now may be the time to strike.